Hello, thank you for joining us for this session on active allocation with passive investing with us at Netwealth. I'm Ian Barnes, the Chief Investment Officer at Netwealth, and I'm joined by Omar Ene, who's a portfolio manager in the investment team here as well. We're going to touch on a few different aspects of what passive investing means and how you can combine that with an active approach to asset allocation, and give a little bit more detail about the Netwealth investment approach and also the way that we're viewing markets at the moment. We've received a few questions already, and we're going to touch on those answers. If you do have any further questions that crop up during the conversation, then please do get in touch with advice@netwealth.com. So first and foremost, we need to decide how we're going to address this question of what is active allocation and what is passive investment. Now, the term passive investment means a few different things to different people, but ultimately it's the question of whether you are taking constructive, active decisions around the way to invest your money. Passive investing implies that you're just trying to follow the performance of a particular market or a benchmark index. Now, that's quite easy when you're talking about individual asset classes like the FTSE 100 index for the UK stock market or the S&P 500 for the US. But as multi-asset investors, there has to be a decision at some point in the time how you're going to build your portfolios and the exposures that you're going to take. Now at Netwealth, we invest in a multi-asset strategy and we maintain the same philosophy across all of our portfolios. We run 7 different risk profiles in each of 3 different currencies. So core sterling portfolios, but also ones that are more oriented towards US dollar or euro based investors. We also have socially responsible investment portfolios where clients want to keep a focus on how much carbon exposure their portfolios are responsible for, and also other aspects of more socially aware investing. But all the portfolios have a very similar approach in terms of thinking about how to build diversified, efficient portfolios. Now, the efficiency comes from the way that we are able to set up our investment team to invest at scale, but it also implies the cost levels and keeping those down as a way to pass on higher returns to our clients. And we have a slide to show the Netwealth investment approach. There are 3 main areas that we focus on. The first is setting the strategic allocations of each of our portfolios. And these are the main decisions that we take of how to build a portfolio that should be delivering on client goals for the next 7 to 10 years. They're based on asset class forecast returns, as well as an understanding of the way that different asset classes behave in their own right, but also importantly, the way that they interact together. So once we've decided on how to build that sensible strategic allocation between different asset classes, there are 2 further decisions that need to be taken. The first one is how to select different instruments that we use to derive the exposures that we're targeting. And that's where a little bit more of the passive investing comes in. We're going to talk about that in a bit more detail. But first, I'm going to hand over to Omar, who's going to talk about our cyclical positioning. Now, where we can see a particular risk within our strategic allocations, we often make adjustments to that positioning on a more cyclical basis. So Omar, can I let you speak to that, please?
Thank you, Ian. So as Ian mentioned, the cyclical positioning is the 3rd element of our investment approach. We would like to describe this as probably one of the more active areas within our investment approach, as in we're proactively looking for risk and thinking about ways of mitigating them, as opposed to the strategic allocations, which tend to be a bit more long-term. The cyclical positioning are more tactical on a shorter-term basis, say around 6 to 12 months. We then overlay these onto our strategic allocations, but at a smaller scale. So relative to the allocations that we have strategically, cyclical positions tend to be a lot smaller, and their impact in terms of contribution to portfolio risk and return also tend to be a lot smaller. How we like to think about our cyclical positioning is trimming around the edges. So taking off a bit of risk here and there just to smooth the path of returns that investors may see or experience whilst invested with us. So why do we do that? It supports one of the key concepts that we hold here at Netwealth, which is time in the market rather than timing the market. So in order for investors to meet their long-term investment goals, we think one of the key concepts is for them to remain invested throughout, not trying to be too clever and trying to pick periods to divest and then reinvest again. Because there's a lot of analysis to support that. If you miss those few strong days, then that can have very detrimental effects in terms of your long-term compounding. So by minimizing the experienced drawdowns, we hope that this will help investors to stay invested and to mitigate some of that behavioral bias that may see people want to divest just at the wrong times when markets are falling significantly. So we've spoken a lot about returning, smoothing returns, and then on the along the same lines, that comes with the concept of risk mitigation. How we like to think about it here at Netwealth is that we see risk as being two-sided. So as much as we want to protect the downside, we want to ensure that the portfolios have adequate risk in the upside scenarios as well, because they're very important in terms of helping investors meet their long-term goals. So moving on to the slide around cyclical positioning and trying to identify those risks. So this is a continuous process here within the investment team, where we continue to look out for these risks and think of ways to mitigate them. So we like to think about this in 4 key areas in terms of what drives asset class returns. So starting off with the macro and policy response. So if you have a clear identification of what the macro policy backdrop is and the direction, you're going to be a good way along the way in terms of trying to identify which assets are going to perform well in that type of environment based on historical precedent. Just a quick example, in terms of periods of strong economic growth, you would broadly expect risk assets to perform well. And in periods of economic downturns, you'd expect safe havens such as bonds to perform well. So areas that we focus on when analyzing the macro backdrop would be indicators related to economic activity, inflation, and also the labor market. We try to look at more timely indicators such as retail sales, industrial productions, consumer sentiment, as well as corporate surveys to try and get a more timely indication of where the trajectory of the macro backdrop is going. Next, we dive into the fundamentals of the asset class. These are the characteristics that determine the worth of what the asset or asset class is worth. I would like to use the example of equities. These could be factors that influence the earnings growth and stability, as well as just the financial position of companies. So you can think about aspects such as revenue growth and mix, trends in margins, the quality of those earnings, how stable and robust are they going to be over time? And in terms of the financial positioning, how strong is the balance sheet, the cash flow generation? All of these elements go into helping us to value a specific asset. And then the valuation concept comes in when you couple those fundamentals with the price. So essentially, if you're getting more fundamentals for a cheaper price, that implies that the asset is cheap. And if you're getting minimal fundamentals or earnings, in the example of equities, for the price, then that would imply that the assets are expensive. On a cyclical basis, valuation has less efficacy in terms of predicting returns. We tend to have more of an emphasis on this at the strategic levels. Your starting valuation has a key impact in your long-term returns. But at extremes, they can also point to indicators on a more short-term cyclical basis as well. So moving on to investor positioning, here we look at how investors are positioned, their sentiment, how they're feeling about the outlook for economies, specific asset classes, and also just the trend. So as we know, markets can trend for some time and follow a specific path if there's no catalyst for a change or a redirection of that trend. So we pay close attention to these inputs as well. And then finally, risk management. This is a core aspect of our investment approach here and is embedded throughout. But with regards to cyclical positioning, we look at the risk at an individual cyclical position level, and then we also see how that correlates with the rest of the portfolio to give an aggregated portfolio impact as well.
Thanks, Omar. Perhaps at this point, you might be able to give us a couple of examples of how you're thinking about the cyclical positioning within portfolios at the moment and some of those more active decisions that are shaping the way that portfolios are invested.
Yeah, for sure. So a position that we have on currently in the portfolios would be our China cyclical position. It's gone through a few iterations, just given how fast the macro backdrop is changing and the narrative regards to US and China is changing as well. But the broad theme remains the same in terms of the thesis was, and it still is, that the macro backdrop in China became so untenable that significant policy intervention was required. And then we expect that to feed through into economic growth and also corporate outperformance. Just going through the building blocks that I've touched upon before and trying to put the China cyclical position into that framework, starting off on the macro backdrop. So we've seen China economic growth moderate significantly over the past decade, or even more so. So going from a growth rate of around 10% to about 7%, and more recently struggling to meet that 5% target. So that's largely due to the issues it's having in its property sector, which is weighing on growth. So at the same time, struggling to meet robust growth targets, they're also facing deflation as well, deflation risk, which can significantly impact consumer sentiment, and it can spiral quite quickly if not addressed. So that was the macro backdrop that influenced us to expect that the policymakers, both on fiscal and monetary, would have to intervene quite significantly to prop up the economy.
Perhaps with that sort of understanding of the way that our cyclical positioning changes through time, I think we might now just touch back on the rationale behind using predominantly passive instruments for investment selection. So the rationale for using predominantly passive investments is to deliver higher net returns to our clients. But before we think about that conclusion, perhaps we can think about what exactly are the instruments that we invest in. So for the most part, we hold a range of exchange-traded funds, or ETFs, on our portfolios. Now, ETFs are an area that have grown substantially over the past few years because they give two key advantages for clients rather than historic types of investing. The first one is that they are funds that offer exposure to the breadth of the market. So an ETF that invests in the FTSE 100 is trying to track the whole of the performance of that index as an entirety. And you can choose one that finds the FTSE 100, the FTSE 250 for slightly smaller companies, and various other benchmark indices around the world. The second key criteria, though, is that they offer flexibility for investors. Rather than relying on one pricing point per day, you can get access to the market at a chosen point in time. So in turbulent times, as we're seeing at the moment, it provides a key advantage in terms of getting money to work quite quickly. Now, the net wealth investment approach tends to be quite strategic. So we don't jump in and out of the market all the time, because as Omar said, we believe a key advantage to investing is that you're able to take the decision to spend time in the market rather than trying to time the market. However, flexibility in the point of investment is always helpful. So an ETF is trying to provide what we would describe as passive exposure to a particular market area. And the reason that we have chosen to build the process predominantly around passive investment through ETFs is that net returns tend to be that much better. So we aren't trying to pick different stocks. We think that that's quite a challenging thing to do on a repeatable basis. And we're also not trying to find the next star fund manager with whom to invest our clients' money. And the rationale for that is that more often than not, in more asset classes than not, over a range of different time periods, we've found that investing in a passive instrument delivers more value after fees than choosing active managers. We've got an example on the screen at the moment which shows over a range of different time periods whether an ETF or the average active manager has performed better in different key asset classes. And we tend to look at these regional building blocks within equity markets and then split out government bonds and corporate bonds on the fixed income side. And you can see that predominantly over most periods, you're more successful investing via ETFs. Now, a keen eye will show you at the bottom of the slide that in the corporate world, It's actually been an average active manager that's done better. And that's for a couple of nuanced reasons. The first is that the differential in fees is that much more narrower. And the second is that you have to put in quite a lot of work just to manage a supposedly passive instrument in this asset class. Corporate bonds have a huge universe of available securities, and all of those securities have a fixed term life. So you're having to constantly turn over that portfolio. So in a way, even a passive investor has to choose strategies like sampling of a huge benchmark index, but also active decisions of when to buy into new issues and what to do with capital that's being released by expiring credits. So we take a balanced view on that. We've held passive instruments in corporate bonds before. We've also held active managers through ETFs as well. So we try to be flexible in that point. So this is our own research. There's also lots of external research that supports the same findings. Indeed, there's a major study from a group called Spiva, which found that in the period since 2002, there were only 2 years in 2007 and 2009 where the average US stock picker outperformed an exchange traded fund. So the odds are dramatically stacked in your favor to take a passive approach. And we think that's really key. It goes beyond just saving on fees. It speaks to the difficulty of different active managers changing their processes to adapt to different environments. And we find it's easier to align this way. Perhaps we can now take those two building blocks of passive instrument selection and more active cyclical positioning and put that into the way that the portfolios are set up at the moment. So, Omar, you mentioned the China equity position, which I think is being held against the broader global emerging markets universe. Yeah. Are there any other characteristics that you would draw out from portfolios at the moment?
This slide shows that our risk level 4 portfolio, which nicely captures all of the different elements within our cyclical positioning and strategic positioning at the moment. So starting off with the equities building blocks, it's safe to say that they're closer to our strategic allocation at the moment. This reflects a more uncertain backdrop in markets with a wide range of possible outcomes.
So that's the broader positioning as a whole. Yeah. I can see that within our equity mix, we've got a wide range of exchange traded funds there. And to me, what you can see by looking at the portfolio as a whole, as it's shown, is that we've often got more than just one building block per regional allocation. One of the other questions that came through was asking whether you always want to be invested in a market cap approach, whereby your ETF emphasizes the biggest companies within an index, or sometimes whether you want to do something that's equal weighted. We've actually got 3 ETFs tracking the US market. Omar, could you take a moment to explain the different characteristics of those individually?
So at the start of the year, we made a decision within our strategic allocation. We saw the merits of investing in the US, but we was a bit worried about just investing blindly or adding to our position blindly into the market cap weighted S&P 500, which is very concentrated in a few large cap tech names. We was worried about the concentration risk there. Being positive on the US outlook, we also added positions in smaller cap US and also equal weighted S&P 500, which aim to still harness that US exposure, but at a cheaper valuation.
And what are the different environments that you might expect the equal weighted allocation to outperform that more basic market cap weighted ETF?
Well, we've seen it year to date in terms of just a broad, if the narrative which had been supporting those few large cap tech names comes under question. We saw the DeepSeek China announcement in terms of their dominance being questioned for the foreseeable future, and the impact that had on some derating there as their investment thesis got challenged. There are more, you can see underperformance there as well. But if there's just a more broader economic uptick in the US, we'd expect equal weighted to catch up there as well.
Yeah, I think that's really important. So we're trying to capture different themes within that one marketplace. So we're taking the efficiency of investing via ETFs, but trying to also reflect different dynamics within an underlying market. Another area of focus that we sometimes get asked about is what we're doing within alternative investments. Now, we always place a high level of importance on liquidity with our portfolios. So 100% of the portfolio can be redeemed at any given point in time. There are no lock-in periods for less liquid asset classes. But we do think it's important to capture exposure to asset classes that offer something slightly different than just equities and fixed income. So the allocation to gold has been particularly rewarding so far this year. And we also have exposure to broader commodities held through an exchange traded asset, but that just gives you exposure if there is some uncertainty around future commodity pricing, which we saw most emphatically happen in the period just after COVID, where there were a lot of concerns about supply chains and pricing pressures. Perhaps now we can move a little bit on. So we've spoken about the strategic allocations and the importance thereof. We've spoken about the way that we can dynamically change portfolios from a cyclical point of view, and also our preferred method of investing via ETFs. It might make sense now just to bring that a little bit more to light and talk about our overall current positioning. So Omar, can you take that on?
In terms of assessing the current macro backdrop and where we go from here, it's probably best to start by giving a bit of context of the years we've had so far. So coming into the year, expectations were quite robust, I'd say. Economic growth was expected to be resilient. We had a labour market that was also quite robust as well, given the context that we've had elevated interest rates, which were in restrictive territory for quite some time. And we've had inflation moderating as well. To add to that, we had the US election in Q4 last year. And the expectations coming out of that is that under Trump's second administration, we would likely see some pro-growth announcements, such as tax cuts, deregulation, and also weaker energy prices, which helps on the inflation front. So markets were caught a bit off guard by just the surprise trade stance from the US in terms of how aggressive it was and also how blunt it was. It had the market questioning the competence of the new US administration, and you saw quite volatile market reaction. And sometimes you could maybe characterize it as being a bit of a panic because of how off guard it was caught. In terms of the reaction from the market, we saw a broad-based sell US reaction. So quite uniquely, you saw all US assets selling off across the board, be that US equities, bonds, and the dollar, which is quite surprising because in times of stress and market panic, US treasuries and the dollar have been historically a safe haven in terms of they see flows, and they usually strengthen during those periods. But just because of how much uncertainty and the question of competence around the US administration, we saw that dynamic playing out as well. But the administration took heed of that. So we had them take a more palatable approach and dial back some of their harsh trade stance. And most to highlight would be the 90-day pause on tariffs, which the market took quite well. From then, we've also seen more market-friendly participants, namely Treasury Secretary Scott Bessent, take a more prominent role in leading the narrative as well. So where do we go from there? Because there's still a lot of uncertainty. We have a few weeks until that 90-day tariff deadline. I think it's the 8th of July comes around. So a lot of time for the narrative to switch. But as I mentioned, in recent weeks, there's been a more palatable approach taken, and there's been a keen switch in direction in terms of trying to eke out some wins in terms of trade negotiations. To highlight, recently we've seen positive news on the UK and China front, but we'll just see how that develops, and especially when more complicated trade partners come into question, such as Europe. Going forward, for the market to be brought back on side, we're going to have to see the US administration act swiftly in terms of getting these deals across the line, and also maybe a more detail in terms of what they actually include and the final destination of where they expect to take US trade policy. So at the moment, given all the uncertainty, we've seen a significant impact in what the market calls soft data. That's more sentiment, how people are feeling. But that's yet to transition over into the hard data. So the real economic activity in terms of GDP growth and jobs, etc. But the expectation is that the longer that this uncertainty persists, that the higher the likelihood that this transitions over and we start to see some real impact in terms of the hard data. Akin to this would be the central bank policy reaction. Different central banks are observing the impacts of tariffs differently. So in the US, the Fed is focusing more on the inflationary impacts, which is effectively holding their hand and stopping them from cutting rates in the expectation that the tariffs will cause prices to rise in the future, and they can't afford to cut rates into that environment. Other regions are focusing more on the economic activity impact. So here in the UK, in Europe, the Bank of Japan as well, they've taken a more dovish tilt towards the tariff announcement, and the expectation is that they're going to cut more in order to support their respective economies. But a lot of bad news is in the market at the moment, and it wasn't that long ago that it was rosy, as I've already mentioned. So we are cognizant of the risk that the market narrative might move on quite quickly if the US administration starts to focus on more of the more pro-growth aspects of their policy, such as tax cuts and deregulation, which they was anticipated in enacting coming into the year.
Yeah, I think that's a really interesting point that we've thought about some of the good aspects of what the Trump administration promised from a corporate point of view, and that was deregulation, lower taxes, and more sort of pro-growth policies. But this amount of protectionism that's really been pushed to the forefront of the second Trump administration compared to the first of tariff impact has been what has really sort of thrown markets off guard. I think the one thing that the slide captures well is just how much uncertainty there is out there. And so for investors like ourselves, where we're trying to take a relatively long-term outlook, then we're very conscious that it's quite hard to think about how you want to be changing portfolios very dynamically day in, day out. We think that our clients will be much better served by a slightly more strategic outlook, staying close to our long-term positioning and picking up some of the returns that we know markets have to offer, and maybe just tilting our portfolios slightly to the areas that we see a little bit more attractive. So that's an introduction really to the way that Netwealth think about managing our clients' money with the three core aspects to the investment approach. I think we should mention that the portfolios have been up and running now for close to 9 years. We've been pretty pleased with the way that the portfolio performance has been delivered over that period. Some sensible diversification of asset classes, efficient implementation have seen us deliver better net returns for the large part against our peer group of other wealth managers in the UK. And I think, Omar, there was one more slide that you'd picked out that talked to that in a little bit more detail and show how we can add value versus the rest of the world.
So here we have a clear illustration of our performance relative to our peers. So the four charts show our performance over various time horizons and different risk profiles compared to the wealth industry peer group. So in each chart, the light blue line indicates our performance, the grey dot indicates the peer group performance, and the navy block indicates the interquartile range, so the middle 50%. So how to read this? If you're above the grey dot, that means you're performing better than average. And if you're above the navy blue block, that means you're in the top 25%. And if you can see across the charts that we're consistently, in the vast majority of cases, deeply in that top 25% or that top quartile of performance, which is quite reassuring and speaks to the merits of the investment approach that we adopt here at Netwealth.
The part that I really like about that is the way that if you extend the time horizon, because we don't anticipate beating the rest of the market like week in, week out, but as longer you are invested, then that tailwind of lower costs of investing and just taking sensible, diversified allocation decisions helps to give you that little bit of advantage against other managers. So we can see that gap growing, that impact of compounding that we speak about a lot. So we need to follow that up with the slide that shows the performance by calendar year. And there you can see that, again, over recent history, how the portfolios have compared to that peer group that's put together by the ARC Suggestus consultancy. And over to the right-hand side, what that means on an annualized basis since inception. So although those numbers might look quite modest at one point as an annual number, when we think about that is spread out over 9 years, then it really compounds up into a really attractive proposition. Well, thank you very much for joining us today. We hope we've given a bit more insight as to how we think about investing portfolios at Netwealth, how we seek to combine the best parts of efficient investment through passive instruments, but also using the flexibility afforded by a more dynamic approach to active asset allocation. If you do have any unanswered questions, or you'd like to speak about the different possibilities of investing with Netwealth, then please do get in touch with our advisory team at advice@netwealth.com. Thank you very much.